Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in and people are broke and drowning in debt and no longer making their car payments. And we haven't even started the technical recession yet, you guys. And unemployment, it hasn't even skyrocketed. And as it stands right now, 1.3 million auto loans are more than 60 days past due. Now, as things continue to get harder and as people continue to get into more debt, we're going to start seeing an auto loan crisis break out. And I think that happens, guys, as early as Q2 of 2023. The reason is things are so hard right now and people are more worried about keeping a roof over their head, putting food on their table, than they are about paying for their sports car. And honestly, guys, this mentality of wasteful spending is almost or just as bad as the lack of accountability from the Federal Reserve. And I'm not trying to hate, but you guys know I'm right and things need to change. Obviously, when people buy a car, that's known as a depreciating asset, right? But regardless, guys, remember, I'm not a financial advisor. I'm just a normal person that went through a whole bunch of bad stuff, okay? And I know a lot of what not to do. And for all of the bad stuff and tragedies and financial collapse I had in my own life, do me a favor, like this video, subscribe if you haven't already, hit notifications, shoot me a comment below. I would love to hear from you. But regardless, guys, let's get started on this video right now and take a look at just how much auto debt the nation is really in. So today we're going to look at a Shift Gold article called Auto Loan Delinquencies at a 10-Year High. And I find it very funny that a gold company, you guys, is writing this article. And they're probably doing that to let you know, even they're trying to tell you, right? Don't buy cars. It's a depreciating asset. They want you to buy gold. But I felt it's really interesting why people do the articles that they do. Usually it just wraps you right around to something they're trying to sell. And I'm not knocking people that are selling things. I'm just letting y'all know how it works, okay? I'm not hating on them, but that's just how it works, okay? And I don't want to keep my head in the sand, and I don't want you guys to keep your head in the sand. Either way, let's get started on this article right now and appreciate them for writing it. This video won't be too long, guys. With prices rising and real wages falling, many Americans are struggling to make ends meet. They are increasingly turning to credit cards and other debt to fill the gap. But that creates other problems. Debt has to be repaid, and a growing number of Americans are struggling to keep up with payments. Auto loan delinquencies have risen to the highest level in over 10 years, according to TransUnion. TransUnion tracks more than 81 million different auto loans in the United States. So 81 million loans, you guys, insane. According to the Consumer Credit Reporting Agency, 1.65% of auto loans were at least 60 days delinquent in the third quarter. That is the highest rate for 60-day plus delinquencies in more than a decade. That's, to me personally, that's shocking. To me, that's shocking. That's you guys, 81 million, that's 1.33 million auto loans right now, 60 days or more past due. 1.65% of 81 million is 1.33 million. So 1.33 million car loans over 60 days past due. Shocking, shocking, shocking. Consumers still want to stay current as best they can. It's just this inflationary environment is making it challenging. It leaves fewer dollars in their pocket to make their auto payment because they've got to pay more for eggs and milks and other things. So here's something crazy that I'm really not going to go into too much. I'm wondering how many people took PPP loans, how many small businesses took the free PPP loans and purchased luxury cars. I know a lot of people did, but I'm wondering how many people did. And the thing, it just all goes back to poor spending habits. I think a lot of people bought these luxury cars because they thought the money was going to keep coming in from the government. I don't know that for sure, but that's what it looks like to me. I mean, you guys, this is just sad because, again, prior to the pandemic, people were saving at a rate of 8 to 9%. After the pandemic, people just lost their accountability. People lost the desire to be adults in good standing. And they've just spent all their money. I mean, this, I don't know about y'all, but like I want to get a deal of my lifetime, but this makes me sad because I'm an American, right? So all of these people making these mistakes, They're also Americans. They're our people. This is embarrassing and this is sad, and people need to do something about it, right? And honestly, and I know there's only so much leaders can do. It's the people that needs to do this themselves, right? The thing is, normally once someone gets out of that rat race, life gets better. Life gets better, not worse. So stop buying cars and trucks that are overpriced instead of buying the home of your dreams. You should not ever buy a new car. You should never buy a new car unless you already have a home. I don't, maybe you shouldn't buy a new car at all, but don't be buying super nice cars until you have yourself an asset. Do y'all get it? Do y'all see? I apologize. Let's get back into the article. Unsurprisingly, subprime or lower credit borrowers are having the most difficult time keeping up with their payments. With loan accommodation programs implemented during the pandemic, some borrowers managed to avoid delinquency. As those programs have ended, delinquencies have spiked. Merchant told CNBC that these programs push some delinquencies into the future. Same with foreclosures. According to TransUnion, 200,000 borrowers who took advantage of the pandemic-era auto loan accommodation programs are now listed as 60 days delinquent because it's a spending thing, right? This is a spending habit thing right here. That's all that is. It's bad decisions. Like most mortgage rates, auto loan rates have increased significantly since the Fed started pushing up rates to battle inflation. The average interest rate on new vehicles rose 5.2% in Q3. Interest rates on used vehicle loans averaged 9.7%, compared with the rising cost of both new and used vehicles, along with rising fuel prices. The cost of owning a car continues to rise dramatically. It is brutal. I went and shopped a new car. It's just a Nissan truck, Nissan Titan, $67,000 for a new truck, for a new Nissan truck. $67,000. Insane, you guys. If we get into a position where employment starts to be a challenge in the United States and unemployment increases, we'll really start to be concerned about consumers' ability to pay their auto loans. And let me ask you guys something. Do you guys think that unemployment is going to go up? Right. I think it is, because our Federal Reserve is attacking the labor market and the lease market, by the way. I don't know if you guys heard the speech from Wednesday, but there was some good information in there that I think a lot of people missed. And really the information is things are going to get worse. Okay. That's what I saw in the speech. But regardless, guys, this is just crazy. I guess what I'm trying to say is we may not have a subprime collapse in residential mortgage, but it is likely that we will have a subprime collapse in auto lending and in the credit card industry. We're going to see that. So stay watching my channel, because if we do see that, I'm going to report on it first thing. Regardless, let's finish out the article. The Federal Reserve blew up an auto bubble with years of artificially low rates after the 2008 financial crisis. The air was coming out of the bubble as the Fed tightened interest rates in 2018. The Fed pivot in 2019, and then the return to 0% interest rates during the pandemic pumped air back into the deflating bubble. But with the Fed now tightening monetary policy once again, the air appears to be seeping out. This is another example of how the combination of inflation, rising interest rates, and the deteriorating economy is negatively impacting average Americans. We see the same dynamics popping up in some other sectors, including housing. This flashes warning signals that things in the economy could deteriorate very quickly in the near future as the deterioration compounds and snowballs. For now, American consumers are managing to limp along using credit cards and savings accumulated during the pandemic, but savings are quickly being depleted as debt has limits. And to put things in perspective, here's the personal savings rate from Fed economic data. This was updated December 1st. And I want to point out, not where we're at right now, but where we were. I mean, look at this. Before the pandemic, we were saving at a rate of 8 to 9%. Okay, of our annual income, right? 8 or 9%. All right, so we're beautiful savings. We were doing really good in 2019, even 2018, saving 7 to 8%, even up to 9%. Lockdowns happened, and it just messed up people's minds. It messed up their spending habits. Look at this. We should have more savings right now because we got so much money from the government, but instead of having more savings, we have roughly 75% less. My question is what happened to the money? 2.3%. This is the lowest it's been, guys, since about I think 2005. Look at the max. Okay, let me go actually 10-year. I mean, even the 10-year. I mean, look at it, 11%. People were saving 11% 2012. Look at that. I mean, beautiful, beautiful, right? And all of that's gone. It's all gone. It's all ended. People are broke, you guys. And when we ask ourselves, why are people broke? Obviously bad spending habits, but when you top inflation and quantitative tightening and rug pull with bad spending habits, you guys, let me ask you this. How are we not going to go into a recession? How are we not? Explain, comment below. Let me know how we're not going to go into recession and have a collapse. And we're already seeing a house price crash right now. We're already seeing that. You want me to tell you where? Austin, Phoenix, Seattle, San Jose, arguably Oakland. There are so many cities right now that have massive declines in home equity. So again, this should be no mystery what's going to happen right around the corner. So in conclusion, you guys, take this as a sign, if you need to, that it is normally way smarter to purchase an asset like a home versus a depreciating asset like a car. America needs to do a better job at living within our means and educating the people on how to be financially responsible. And that goes with you and I as well. You and I need to continuously educate ourselves and even other people, because the reality is, you guys, life is really hard and people are careless with their money. And most of them that need help, you guys, don't even realize they need help until it's already too late. In other words, just don't be going out right now and buying a new car when right around the corner we may find the deals of our dreams, not only in the housing market, but also in the auto market. If we have a flood of repos, you guys, what do you think that's going to do to the prices of used cars? Obviously, what that's going to do to the prices of used cars is it's going to decrease them. And again, you guys, what I am saying is just sit tight right now. Let the dust settle. Let the quantitative tightening do its job. If you want to get back into the market, do it after the pivot. If you want to get in the market sooner than that, follow the data, become an expert, you guys. And other than that, I really hope you guys got some value, some insights, and some perspective in today's video. If you're out there investing in cars, or if you're investing in real estate, I do wish you luck, and I hope you win.